Welcome everyone to the final video in the three-part series, an AST exclusive that shows you the best way to use an annuity in retirement. This is where we put all the pieces together. To briefly recap, in the first video we looked at the importance of retirement planning through the 5 keys, which is generate lifetime income, avoid volatility, combat inflation, maintain control and flexibility, and leave a legacy for spouse or heirs. The best way to use an annuity in retirement allows you to maximize benefit in each of the 5 areas and will prove why an annuity, when used the right way, is the preferred asset. In the second video, we looked at the most common solutions to retirement planning and scored each based on the 5 keys. First is market-based investment management. That would include your run-of-the-mill stocks, bonds, bucket planning, systematic withdrawals. But because of market risk and the interest rate sensitivity of bonds, this strategy produces a lot of question marks. Next is a single premium immediate annuity, or the traditional use of an annuity where you take a portion of assets, secure the income you need to guarantee income free of market risk. But because this is expensive as a result of the low rate environment, there typically aren't enough assets left to get real growth to offset inflation or leave a legacy. And finally, the new product that's all the rage is an index or variable annuity with a lifetime income rider. Here you'll get an income guarantee, but fees will cause poor performance that put volatility in question, and this does nothing to deal with inflation, keeping control of your money, or leaving a legacy. We went over this in greater detail in video 2, so I'm just giving you a quick review. You may notice that mixing and matching can give a little more assurance in certain areas, and if done correctly, may lead us to the optimal solution. The ideal solution will provide you with the perfect allocation so you can handle all the concerns in retirement and instead spend more time enjoying your hard work with the people most important to you in the places you've always wanted to see. And I will give anyone extra credit who can name that iconic American landmark in the background. Now, are you ready for some good news? There is an ideal solution that puts you in position to maximize benefit in all the 5 key areas of retirement planning. Income can be covered without a lifetime commitment. A guarantee that money will always be available to draw what you need or want is no different than paying an insurance company to guarantee it. You only take the amount of risk you want in a way that doesn't decrease the guarantee and protection you need so you avoid volatility and risk of loss. This solution typically costs much less, leaving more assets available for the growth needed to offset inflation. Plus, the annuity is short-term, so you have the ability in the future to make changes that align with current market conditions at the time. Flexibility is the best way to position yourself to beat inflation. The free withdrawal available in the right annuity is enough to secure the income you need, and excess withdrawals can also be taken in order to rebalance the portfolio by way of alternative investments so you have more control over your assets than any other strategy. And a legacy, for those of you who care about it, I will show you how this strategy allows for more growth and a much higher remainder than you'll get with any other strategy. If you don't want a legacy, you can spend more money, but if you do, it will be there. Now, wouldn't this look great? No worries. So what is it? It's a deceptively simple application of an index annuity without the income rider. I call it the AST Flex strategy. Use the annuity instead of other conservative market-based allocations and you get the best of both worlds: safety, protection, and reasonable growth. You can eliminate the rider fee and the savings will enhance growth substantially. Replace other safe allocations that are interest rate sensitive like bonds and have access to the funds you need for income because of the principal guarantee. Most importantly, you're not locked into the contract beyond the surrender schedule, so you can always move. If market conditions change, you are not locked into today's decision forever. Any of you might spend several hours or weeks investigating this. Some take a year or more to make a decision. You need to understand that I've been doing this for 17 years and I've seen just about everything out on the market. I do this all the time, but you only get one chance, so you have to do it right. In summary, this strategy simply offers more. By using simple tools like index annuities without complex riders, we accomplish more safety, flexibility, lower fees, and give you more overall output. Using this strategy, you increase income, protect yourself from volatility, position yourself to beat inflation, stay in control and preserve options, and if you so desire, can position a legacy as well. In short, this is the most sensible, safe money strategy, and no one else is doing it because it's easier to just sell lifetime income contracts that last forever. Now, I'm going to show you how this works by looking at a couple of case studies. Ted and Cindy, age 73 and 68, combined IRA assets of $375,000. They don't really need any extra income, but they need to manage their RMDs. Half the money is in equity funds and a half in bond funds, and they are at the point where they don't want to take risk and want to start limiting market volatility. They made the rounds to a bunch of different people, and 3 different people said the same thing. They wanted to put half of their money into a guaranteed lifetime withdrawal benefit index annuity or a variable annuity. Any of those contracts were going to pay them about $9,000 annually for life. But is that the right move? Now, in this example, I'm simply going to show you the better way to use an annuity, and I'll go into more detail on the second case study because Ted and Cindy are still very much in the process of figuring out the whole thing, but we started with just the annuity. Ted found the website and watched the webinar, realized it would take him 20 years to break even with that asset. He'd be well into his 90s by then, and the annuity would not cover RMDs, so it would take a specific type of planning with his additional assets. He thought skipping the income rider would be more efficient. It's a classic case of him just understanding and finding out there's a different way and you don't have to do it like everybody else does. And you know what? He was right. They split the purchase between a 5 and an 8-year index annuity contract. Neither of the contracts had a fee or a rider, just a 10% free withdrawal. If they get no growth, they produce the same results over 20 years. But with moderate growth, and moderate by that I mean 2.5 or 3%, they could do much better. They're going to have more than half the money left when Ted is 93 years old. Because the income rider would have cost them nearly $40,000 over 20 years, Ted and Cindy have more money. That means they can take more income, and reducing volatility goes without saying, as both annuities would do that. But more money gives them more opportunity to combat inflation by way of income increases or planning changes over time. And they have far more control over the outcome. They can choose how much they want to take out every year, or even rebalance the total portfolio in 5 to 8 years. And of course, with conservative projections showing a healthy remainder, there is obviously room for a legacy, but that's up to them. So like I said before, there's more to it for these guys, but I'll explain all the additional opportunity in the next example. Okay, in the other case study, I will go into a little more detail. With this, it was Dan and his wife, who are 67 and 64, with combined assets of about $1 million and a plan to retire in 3 years. We figured out that Dan and his wife had about a $30,000 projected income gap. Dan's goal was to protect half of his assets, so he got a letter in the mail and it invited him to a dinner seminar. And after the dinner, he made an appointment with the local advisor. The agent proposed half of his assets going into an index annuity with a guaranteed lifetime income rider. That's about all they ever come up with, so he was no different. It was a competitive contract, but the growth potential was limited, and the rider cost 1% annually in fees. Now, Dan watched the video series and he gave me a call. When we first talked, I asked what he liked most about a different approach. He said he wanted similar results that would give him more control over the assets. So this didn't give him control because it would take 17 years of payments to break even. Right when the best projection on the other contract showed a cash value of 0, he would be 87 years old. He can use the same strategy as we used in the previous example and maintain control while having a substantial remainder after 20 years, but have control over the assets the whole time. For all the same reasons as Ted and Cindy, he will be in a better position by skipping the income rider, which in this case would have costed Dan more than $100,000 over 20 years. But I'm going to take this one step further. You need to understand first that the problem with all the other annuity strategies is that the annuity is removed from and works independently from all other assets. This dramatically decreases potential and does not allow for you to address all the 5 keys of retirement appropriately. I'm going to show you what I mean. Here's the basis for my recommendation. Split the allocation between an annuity and market securities. The exact mix is going to depend on income needs and personal preference. And don't forget that Dan wanted to protect half of his assets. It could be more or less once we determine the best way to use an annuity. This gave Dan the safety he wanted and the growth he needed. Or it could be said the opposite. The safety you want and the growth you need, right? From here it's simple. Take the income from market assets when you have a gain and from the annuity when the market is down. You maximize growth when you can allow securities to recover in value after a correction. Fees are immediately reduced because the annuity has no fees. The only fees you'll pay is going to depend on how you want to handle the other assets. Dan has the flexibility to rebalance both allocations at any point in time, and remember that none of this can be done with fixed income for a fee. Let's look at a spreadsheet that I use to compare different annuity strategies over historic market scenarios. With Dan's strategy, we add another layer to show that it's about more than just the annuity you use. So let's see how his portfolio is affected with and without an income rider. I'll even add a required inflation adjustment to the income goal so we can plan reasonably and cover all concerns. I'm going to prove once and for all why this is the best way to use an annuity. Okay, here's a spreadsheet that I use to show different strategies. I can compare annuity strategies, bonds, different stock mixes, everything, but I'm going to keep this simple, okay? Like I said before, when you use the annuity, you remove it from all other assets right here. So he's got $500,000 left in the market. He's got an income goal of $30,000. There's a 3% inflation adjustment, and he's going to wait 3 years to start. Now, the annuity is not dead. What it does is it gives him $30,000 a year. So what that does is it means that in trading that asset for income, he no longer has to rely on his market portfolio for anything other than just the inflation adjustments. With that, you can see when the market is up, you draw from gains. When the market is down, you sell principal. The result of doing this over 20 years is that he has $800,000 remaining in his portfolio, but he's adjusted his income the whole way. I would consider that to be a reasonable outcome. And in this situation where he needs 3% of his assets for income, then he has a lot of choices as to how he can go about it. But let's get rid of the income and let's put the annuity back in the asset column. By doing this, you have a lot more flexibility, and I'll show you why. When the market's down, where it drops here in these terrible years, and the worst, this is the Great Depression, he could lean on the annuity entirely up to 10% free withdrawal to take money out of it, okay? Leaves all of his market assets alone and only takes from the market when there is gain on the asset. By allowing the market assets the maximum amount of growth potential possible, he comes through the 20 years with more than $1.2 million. Okay. There is a lot of ins and outs to this, a lot of different ways I can do it, and the point of this is not to get you fully comfortable with the spreadsheet, but just to show you how I can prove the best way to use an annuity. In some situations, it goes the other way, but in most cases, there's a dramatic increase in results by doing it that way. So Dan's results over the worst 20-year period in market history. The income annuity provided a remainder of $800,000. Okay, that's not so bad. But the flex strategy gave him more than $1.2 million in remainder. This is kind of where I joke with people, and I told Dan, hey Dan, if you buy an annuity from me, I'm going to give you $400,000, which is not, it's a joke, of course. I'm not going to give you a whole pile of money, but I will show you how to make the most out of using an annuity and how you can benefit from it substantially. One major question is, what if we don't repeat the worst 20 years? We might not have a market that looks like the Great Depression. Well, he is paying no fee for the annuity and has higher growth potential because of it. So he can take additional free withdrawals and invest more in the market. Or the portfolio can be rebalanced in the future to pursue more growth if that's what he wants. So let's look at how this scores in relation to the 5 keys. I showed a way to plan for greater income using the flexibility of proper asset allocation. Income, check. He had enough safe money available at all times to survive the worst 20-year period in market history while still increasing his net worth in retirement. Avoid volatility, check. Planned increasing income with a larger account balance at the end, both of those together, it does not take a stretch of the imagination to give inflation a check. Discretionary withdrawals from either side of the portfolio and opportunity to incrementally rebalance along the way or when the annuity is surrender free. Control and flexibility, absolutely. Legacy, check. Dan can spend more money if he wants to or leave it to his heirs. That's his choice and it can be yours too. So I'd say we have it all accounted for, but the biggest question still remains. Why index annuities? Well, I was skeptical at first. When I started using them, it was in a small way. I realized that there's nothing to be worried about because over time growth has been proven to beat fixed annuities and bonds. The major advantage is liquidity free of risk in the index annuities. Fixed annuities are restricted to interest-only withdrawals in the highest rated contracts. Now there's some that still have a 5 or a 10% free withdrawal, but companies like New York Life, they're not even trying to buy that business. You're going to get 1.5%, maybe 2% in the contract, and that's just not going to do it. Bonds are subject to interest rate risk and fluctuating value, so there's no great amount of liquidity if needed to offset market volatility. If you're interested in using the AST Flex strategy and you want to get started building yours, get on my calendar by clicking on the link below these videos and I'll give you a call. The initial consultation will not take more than 30 minutes. I simply need to know your goals and what you have to work with. We'll put all the emphasis on the 5 keys of retirement and what's most important to you. It will not take me long to tell if the Flex strategy is right for you. If it's not, I'll give you as many pointers as I can and send you on your way. In closing, I want to drive one point home. I want only what's best for you, and my goal is to help. A few weeks ago, I wrote a newsletter about the challenges a retiree faces while trying to find the best deal. A person I met with a few years ago left a comment to that post. What he remembered about my advice is that I told him he probably didn't need an annuity. An excerpt from that comment is on the screen now, and it shows it's not my goal to sell an annuity to every person I meet. My goal is to help you find the best way to deal with retirement. I appreciate your time and the opportunity to help with your retirement plans. I wish you all the best and look forward to hearing from you soon. Thank you and have a great day.